Only going to go to 11. It says 11:30, but we're only going to go to about 11. Okay. How are we doing on count of people?
It's going up.
Okay.
Lots of people joining.
Okay. Hey, everybody. We're going to get going in just a minute. Thanks for being here. We're up to 43. Okay, we'll just let a little more trickling happen and then we'll get going.
And are you recording this session?
Oh,
Yes. Yes, we are.
Yes. So careful what you say. All right, let's I think we will start then. Hey, everybody, thanks for being here today. I'm Ken Rother. I'm connected to Cornell and I'm the director of Rev, the business incubator in downtown Ithaca. And we're thrilled to have an opportunity to have three great panelists with us today to talk about funding sources and specifically folks who really do, focus on New York State and working with companies in New York State. So let me quickly introduce our folks. We have Jennifer Teagan, who's the managing director at New York Ventures Empire State Development. And each of the speakers will have a chance in a couple seconds to really get into what they do. Marnie Levine from Launch New York up in Buffalo. And we have, one more slide, Somak, who's with Armory Square Ventures based out of Syracuse, New York. So thrilled to have them all. Let me just stop sharing my slides now. And I'm going to ask each of you to kind of introduce yourself, talk about your fund, how long it's been around, what you focus on, typical companies you invest in, criteria, check size. If you could each spend a few minutes kind of introducing yourself, that'd be great. For folks in the audience, if you have questions, put them in the Q&A and we will get to them throughout the session. So as questions come in, we'll kind of reach out to the various panelists and bring them up. But let's start. How about Jennifer Teagan? How about you start?
Great. Hi, good morning, everybody. It's great to be here and not be able to see you, but at least feel free to shoot me questions later too. So I'm the managing director of New York Ventures, which sits within the government of the state of New York, the Empire State Development, our economic development agency. And it's a $220 million program to invest in high growth and innovation startups across the state. Just a quick background on me. I spent the better part of my career now in venture capital, 18 years as part of Cayuga Venture Fund. I am based here in Ithaca and was one of the partners at Cayuga Venture Fund for that period of time. And then, I suppose when the opportunity came up with New York State, it was, spending the better part of my career, not seeing much of the needle move relative to regional access to venture capital, as well as for people of color and women founders, wanting to see if doing that within the agency at the state of New York would be helpful. So took over New York Venture, or became the managing director at New York Ventures in March of 2020. It was a complex time to be working for the state, but it was also a great opportunity. And so our focus is we have direct investment programs and indirect investment programs. Some of the things just launched recently, actually, based on some federal money that we got. So I'll probably get into that in a little bit. But fundamentally, we have over, $130 million for direct investments in Series Seed to B startups. We invest anywhere from about $250,000 up to $3 million, depending on the need of your company. We match private sector dollars. We don't lead investments. We don't like to compete with the private sector. We're really just trying to fill in the gaps. And how we define gaps in the ecosystem is around access to capital broadly, and access defined by the background of the founding team, or the founders of the company. So women and diverse founders are certainly a focus area of ours, as well as geography. So basically anywhere outside of New York City is less well served relative to the capital markets. So we focus on those areas a lot as well. So about half of our investments are outside of New York City, actually a little more than half. About 70% of our founders are diverse. And then the last bucket of access is around industry sectors that are both strategically important to the state, but also sometimes a little harder to get initial sources of funding, including biotech, life sciences, healthcare, advanced manufacturing, agriculture, things like that. So, and then we also have a pre-seed and seed fund, which launched in January. We match up to $250,000 one-to-one with private sector investors. And then we also have an emerging manager program and an accelerator partnership fund. And I'll stop there because I probably went over a little bit.
That's awesome. Thank you. So Matt, why don't you tell us a little bit about Armory Square and yourself?
Sure. Good morning, everyone. Thanks, Ken, and excited to have be in a discussion with Jennifer and Marnie. We excited to meet all of you in the future. So yeah, Armory Square Ventures. We've been around since 2014. We're headquartered in Syracuse, but we also have an office not too far away in the Finger Lakes in Skaneateles, and we also have a New York City office as well. We primarily focus on leading post-seed and early Series A rounds, primarily focus on B2B software, although we've done some consumer-facing technology investments as well. And although we can theoretically invest anywhere in the US or Canada, the vast majority of our capital has been invested in upstate New York. I'd say over 90% in Fund 2, our most recent fund, probably 60% Fund 1. We're very fortunate to now be, we're about to start investing out of our third fund in the next few weeks. So we currently manage just a little under 100 million in committed capital. Most of that is actually now in our Fund 3 that we'll be investing in the next few weeks. In addition to the focus on B2B software, we have we really try to focus on areas where we can recruit talent and follow-on capital. So our companies have attracted almost $2 billion in follow-on capital, and in many cases, this is the first time some of these later stage funds have ever invested in markets like upstate New York, which is very exciting for us. And we tend to take a concentrated approach. So we'll basically aim to do 10 to 15 companies per fund, and where we really focus not only on the initial check, but really having large amount of follow-on capital reserved for the future rounds. So that's a little bit about us. My background is I've been a VC since 2005. Prior to this, I was at Tribeca Venture Partners in New York City. And I started my venture career at Edison Partners, spent the first 6 years of my career on the startup side, initially with an e-commerce company that was acquired by eBay, and then a digital health company that was also acquired. But I'm very proud. I'm on this panel. I'm probably one of the more recent transplants to upstate New York, but I've been here now nearly a decade. So I guess I definitely feel like upstate New York is home, and excited to talk more about investing in this region.
So thank you. And Marnie, and please introduce yourself and what everything going on at Launch New York.
Absolutely. Marnie Levine, I'm president and CEO, co-founder and fund manager at Launch New York. We're a little bit different animal from Somac and Jennifer's funds in the sense that we are a venture development organization. So I lead a nonprofit that is intended to address the lack of capital for risky startups, as well as the entrepreneurial talent gaps, I would say, in upstate New York. So Launch New York is 10 years old this year. We started our fund in 2016, but we are modeled after other organizations around the country, many of whom have actually been state supported, neighboring states like Ohio and Pennsylvania, where we found that the lack of venture-backed businesses being, an issue for upstate New York when we're trying to grow all these new economy businesses is something that we needed to tackle with a model. So a venture development organization essentially is here to identify, support, and fund high growth potential startups on behalf of both job and wealth creation, as well as growing the overall entrepreneurial ecosystem. So our mission is certainly returns for our for-profit investors, but it is also economic development. We are a community development financial institution, and what that means is the majority of our investments, frankly, happen naturally because upstate New York is still economically depressed. We have over 70% of our investments are in companies that are in low-income census tracts, low-income neighborhoods. So when Jen refers to underrepresented founders, underserved, under-resourced founders, that is really the focus of Launch New York, with both our mentorship first and then funding. We became the most active seed fund by about 2018 because the need is so great. So we're typically writing checks in the 25K to 100K range from a variety of our funds as our first investment, and we can go up to several $100,000. We do have a variety of different funds, nonprofit fund, as well as for-profit funds, and even an investor network for deal-by-deal for-profit investments. So Launch New York has created what I would call an invest local financing suite, so that we can work with startup companies who are generally with little or no revenue when they come to us. So you're around when you're thinking about coming to Launch New York, and I see a lot of familiar names and some of our portfolio companies even on today with us. Generally, you're going to be raising a 6-figure round. We occasionally first-time investments in a 7-figure round, but our goal is to be here for those who have not had access to capital. We naturally have almost 50% of our portfolio companies led by underrepresented founders. And I guess a lot of that comes from, myself as a founder of health IT companies. I was a co-founder with folks out of University of Rochester back in, yes, the 1990s. So having this experience of growing a company through venture capital and then actually going to a healthit.com in New York City in 99 and going public again. So twice IPOing in that space, and just realizing that this was somewhat of an unusual pathway for people in upstate New York. And now we're excited that everybody who's on this panel, and Ken's been phenomenal as an investment committee member for Launch New York, helping us invest in seed stage startups. That is our commitment. We're investing anywhere from 2 to 4 companies per month getting our capital. So we have a portfolio of 87 companies at this time. And, we're generally first money into companies, and we do serve all sectors. And I'll just give you my last little point to note. Generally speaking, while we know you have little or no revenue when you come in and apply to a Launch New York online at launchny.org, our desire to help you is for you to be using equity capital to grow your business. So we want you to be willing to consider equity capital, but we also need you to have a vision towards at least 10 million in annual revenues by years 5 to 7.
Thank you. So let me start with Jennifer. I had some specific questions. You I think you have the biggest team here, and you several people. How does it work? I mean, are people assigned geographies, domains? Sort of how does your organization function, and therefore how do people maybe work with you?
Yeah, so we I do have a team of I think I'll be up to 9 soon. And a couple of those are specific to the like our pre-seed fund. And Marnie, I hate to admit, but I hope that I beat you on the largest number of seed investments before too long. Just kidding. But anyway, so yeah, for people to reach out, generally we're on LinkedIn. You can find any of us. We respond pretty broadly. We're a state agency, and so our job is really to try to be as responsive as we can. Although we are capacity limited, we do have a great amount of deal flow. But our team is, we have several people upstate, several people in New York City, and then we have a couple of people who are a little bit more vertically focused. In particular for life sciences, I have a woman in New York City named Sylvia who is very focused on life sciences. Generally, I have a person in Albany, Clayton Besh, who is often our manufacturing guru, advanced manufacturing, as well as clean energy and climate. But we all kind of scatter ourselves around based on opportunities that we like and find interesting. I have Marcia Mitchell on the direct deal team, who is focused a lot on computing and B2B computing, data, AI, SaaS opportunities, especially, but she's also getting into healthcare at this point. So, yeah, so it's pretty widely spread. We have a new person starting in Buffalo soon. So that's exciting for us. So 2 Albany, 1 in Buffalo, 2 in Ithaca. The other person in Ithaca is somebody who is managing the Emerging Manager Fund, Ryoko Nozawa. So some of you may be familiar with her already too.
Cool. Let me ask Somak a question here. Somak, so I think you're very focused on SaaS kind of companies. What stage do they need to be at? Like, what are you judging? Do they need revenue already? Letters of intent? What kind of traction gets your attention?
Yeah, sure. So first, yeah, we do focus on software business models. SaaS is not a requirement. In fact, our most successful investment ever was a marketplace model, right? ACV auction. So we probably, within software, we have a preference for repeating or recurring revenue models, which can be either SaaS or marketplace generally. We tend to avoid more project-based models that are more one-time fees or consultancy type models. But in terms of what we're looking for to get excited about investing, about 25% of our investments have been pre-revenue. So we can invest at the seed stage. Our preference when we do invest in seed, though, is to back an entrepreneur that we've worked with in the past. In some cases, already had a massive exit in the industry. So we're less worried about the company taking a product risk. Although we've made exceptions too on that note when we're sufficiently excited about the entrepreneur. But most of our businesses, because they're focusing on B2B business models, will typically have a few customers in place, and they may not be large contracts. In fact, they may not even be generating a lot of revenue, but we have enough evidence of product market fit where those customers are referenceable, can tell us about sales implementation cycles, about the value that they've seen, the ROI that they've seen since working with that software solution. And then just as importantly, if not more importantly, we can then use the product that they have already been piloting with customers to our own network of customer prospects. And that's where we really spend most of our time. When we get the company to actually demo the software or the tool to other key decision makers, we try to get a quick read of, is this a must-have or it's nice to have? Can this truly be disruptive? And ultimately, can this one day, if they do actually start monetizing and charging the right type of subscription models or repeating transaction-based fees, can this be something that could be $100 million revenue business in 5 years' time? And we actually saw that in ACV, we saw that less than 5 years' time. So it's an outlier, but we know most companies won't get there. Bento Box got to double-digit millions revenue in less than 5 years' time, but that's the general heuristic we apply when we look to make an investment.
Marnie, you, I think, maybe write the checks, the smaller checks at the earliest possible moment you can get away with it. So how do you do that? Like, what are the challenges being like the absolute often first money in kind of investor? How do you think about that?
Yeah, we really enjoy being the first money in, but we also appreciate it's somewhat of a unique place because the companies, generally speaking, do not have the kind of track record. They don't have the product market fit proven out. They don't have generally revenues, and the product may not even be completed. So for us, you could say all of those are challenges. It's a company that's hardly formed in many cases. We do require companies to be incorporated to start working with them. But I would have to say that the biggest challenge for us really comes down to the people. Because as you heard me mention before, it's certainly not the current revenues that we're basing our investment and work with the client on. It's the vision. And it's really all up here. And I personally feel like that is what all of us are trying to do, is to show that upstate New York and New York State as a whole really can be at the forefront with innovative ideas that are scalable at not just a national, but global level. So having an entrepreneur who can think at that size and scope and be willing to, quote, go there. So along with having to have a $10 million in annual revenue forecast by years 5 to 7, We do require that there is a business lead willing to take the company forward. Now, that may be a faculty member out of a higher ed institution. Most of our companies are not actually affiliated with higher ed. So it needs to be somebody who's willing to put the time and effort in working with our mentors and trying to discern whether the person talking to us on the telephone, on a Zoom call, or meeting us at an event is that entrepreneur is something none of us know. We do use leadership assessment when people come into our investment pipeline, but even then we're not really sure. So I would say that having a coachable entrepreneur who is willing to learn and work with us, and more so work with ultimately more and more people. We do know that an individual entrepreneur, for any of you, and I know there are some that I see, I recognize, who are solo entrepreneurs right now, but if you're going to be in a scalable business, you are going to need a team, and the ability to work with others, to work with your investors. I have to say that's the most important point. And I guess in the VC world, we all agree that it's that management team, or in our case, that management person, that founder, who really is the most critical. And that's probably our biggest challenge. We really don't know, but we're willing to give you all a shot. So we start out with an intake call where we have that conversation, talk to you about the fact that we use lean startup and business model canvas approaches. And that willingness to engage in mentorship is probably our first gating mechanism. And we do require a minimum of 3 months participation in that process. So that's the first step in really traveling what we feel is going to be a journey to become a scalable business.
Cool. So actually, I have a question for Jennifer and Somak. I'll ask each of you, Jennifer and Somak. What role, I mean, you come in a little later often, what role do you all play in terms of corporate governance? Do you typically take board seats, observer seats? Is there a, Jen, we'll start with you.
Yeah, so being part of a state agency, we don't take director seats at any company. There's a, political risk potentially that we always, have in the back of our mind around things like that. But for when we are investing typically more than 250, we'll ask to have observer status at the company, especially for the earlier stage companies, seed to A. Mostly in part because we find that that's when we can provide the most benefit based on our experience, our connections, our ability to kind of follow track and help a company with the additional, network and resources that they might need. It's not that they don't need it below 250, they do. But with the pre-seed seed fund, we're hopeful that they're getting that with, it's part of the reason we're a matching fund, right? So unlike Marnie, who will lead deals, and she plays such a special and important role in the ecosystem. And I really love, what Launch is doing with the mentorship and all of that, because that's all really important. We're looking to partner with programs like Launch on our pre-seed fund so that they are, those companies are getting that accelerator or mentorship. An opportunity to grow and thrive with guidance from people who have been there to help those businesses. But we're happy to help with additional funds to get them over those initial hurdles that they need, those milestones that they need to meet. I'll go ahead, Somak.
Cool. Yeah, Somak, what about you, corporate governance wise?
Yeah. So in terms of board seats, we have generally held board seats at the majority of the companies that we have led rounds in, and I think we generally have observer seats for the other companies when they get to a certain stage and have raised a lot of capital. But our general philosophy is that we want to partner with entrepreneurs who don't look at a board seat as a concession that they're making. In many cases, our CEOs are thrilled to say, okay, you're the VC fund that backed XYZ companies and took them from this stage to an IPO or to a successful exit in these markets like upstate or other secondary markets. And so we tend to want to work with entrepreneurs who really are excited not only about the capital, but the time that we'll be spending rolling up our sleeves to really help on the company building phase and supporting the entrepreneurs. Now, on the governance side, we spend a lot of time on trying to find ways to kind of create best practices. So governance is not only having board meetings, it's also information reporting, which again is not just about satisfying the needs of the investors. It's also about making sure you have the right metrics in place to actually run your business better. And so we spend a lot of time well before we even make the investment saying, these are the mutual expectations. Here's how we're going to know that when we actually follow these particular, principles in terms of how we report, how we manage the business, how we work together as a board, raising that Series B should be clockwork. Like we can really like months before they're ready for a Series B round, say, we know the company is executing in a certain way. And now whichever Series B funds could be right prospects could ultimately, be ready for that next stage. So this is all for running the business and also getting ready for making sure that you get the next round raise. And we've had 100% hit rate in terms of going from Series A to the next stage in our fund.
I'm going to project and say I think all of us, and I'll include myself in we all have a little bit of the upstate chip on our shoulder. This place is special and not everyone gets it yet. So could you, each of you, I'll start with Marnie, sort of maybe point to one success where, it took a while for the rest of the investment world to realize it was an interesting opportunity, that you all saw first. We're just not there yet, but because the three of you exist, these opportunities are getting funded and other folks only maybe find out just a little later. Marnie, what do you?
Sure. Our timing of this webinar was great because we just had one of our first major exits with Patient Pattern, a health IT company that honestly, I knew this company back 2013. They got going and we're doing 1 minute pitches at our venture forums we were running. And, essentially it's a company that was led by a geriatric nurse and a gerontologist who were trying to create a way to better identify geriatric patients who were, going to the hospital, being discharged and then landing right in the hospital again. So it started out with a frailty index. And I would tell you that during the pandemic, we certainly worried about many of our companies. This company was growing, but they were selling into long-term care facilities. So with the pandemic, you can imagine the impact that had. So we saw incredible grit. And when I go back to the team, could I have said that this was the team that would have had the grit to figure it out and in the pandemic pivot to actually being able to sell into healthcare systems who could use the algorithms and the sophisticated software to essentially help address identification of patients, not just in long-term care facilities, but across their whole health system. So this company grew tremendously and actually just announced their acquisition last week by a Canadian company called Point Click Care. And we're just thrilled that, this will yield returns back into not only our nonprofit fund so that we have an evergreen opportunity to keep funding all of you out there, but also to our for-profit fund so that investors in the region are starting to see that these successes can happen. So Mac, of course, mentioned ACV auctions. Everybody's wanting to see that these companies can persevere. I think the biggest lesson for all of us, though, is the markets, obviously, right now, particularly, are incredibly challenging. But with grit and with support resources that will come in at a 5-figure stage. So this particular company, Patient Pattern, you start talking about 2 and 3 rounds of funding that we're doing, even in a seed stage company, right? Who's then moving to a Series A, right? It's a process. So there are no quick wins in the scalable business space, but we're super excited that Patient Pattern is leading the way and showing us that we can have many more of these successes.
Yeah. Sure, very exciting. So Matt, what about you? Is there one you found early that maybe your out-of-state colleagues wish they knew about?
Who was that? Was that for Jennifer or me? Who was it?
For you, so Mac. Yeah.
Oh, yeah. Well, yes, we've obviously talked about ACV, Clario Vision, there's so many I feel like pretty much every company that we work with upstate, I'm curious what, Jennifer and Marnie feel about this too. I think when I talk to my friends in Silicon Valley and say, how many other VCs have typically met with this particular entrepreneur? I said, none, like almost none, right? They find that quite unusual. I think that I will just say that you know, when I think about what's interesting about being upstate, yes, I probably do. I think I agree. I have a chip on my shoulder. I consider myself an upstate New Yorker now. And I think one of the things that's so fascinating about being an investor, talking to companies in our region, is in many instances, they're dealing with industries that are not the focus of many of our peers in larger metropolitan markets. So, you know, the idea, you know, whether you're talking about automotive dealers or you're talking about manufacturing software, this is not the things that come up in cocktail conversations and VC events in New York City, as someone who worked in New York City for 10 years. So it's really exciting when we talk about these markets that have massive TAMs, massive total addressable markets that are just in the early stages of embracing software innovation. We get to talk to our LPs and colleagues who live in our towns who are not all tech bros or VCs. And we realize these are huge opportunities. So it gives me a tremendous amount of pride when we see those companies then raise those Series B, Series C rounds or see successful exits. And all those VCs who said it was impossible to be a big business and seeing them scale, then paying up in valuations and clamoring to get into those companies. At least that was the case for much of the last 5 years. To Marnie's point, the market is definitely very different, especially in the last few months. But I think that's something that is, I have a great deal of pride in.
I want to get to some other questions. So I'll get this one to Jen first. And I've had this question come up a lot. It showed up here, and I've had this question come up a lot with entrepreneurs I work with and back in the classroom and whatever. How do you all, and I'll start with Jen, how do you all think about previous funding? So if a company did either, you know, pure friends and family or maybe a Reg CF, an equity crowdfunding round, plus, minus, does it matter?
Depends a little bit on the company. Sometimes I actually refer companies to do crowdfunding. I think there's some great reasons, especially if you're a consumer-facing company, and it allows you to build some, you know, real validation for the investor community and what you're trying to accomplish and do, that I think can hopefully make it more attractive. So I personally, I think crowdfunding plays an interesting and helpful role, especially when you're talking about underestimated founders who may not have traditional access to other sources of funds. I think that crowdfunding can, you know, level that playing field a little bit. Probably not enough, but a little anyway. And so, and then, you know, friends and family, like we just from the public side, we're always a little more careful. Like we like working with people who have track records as investors. And, you know, for, you know, just in part because we know that those people, if they have other companies they've worked with, they can provide a little more guidance and all of that. So, you know, those things are things that we factor in. So hopefully you have some experienced, even if they're a friend, somebody who's experienced in doing some investing anyway, before you come and meet with us.
So Matt, what about you when someone shows up, if they, I don't know if you've had this case yet where they've done a Reg CF, an equity crowdfunding, plus, minus, and different?
Yeah, I agree with Jennifer that, you know, it's nice to, you know, we having some in certain sectors, like, you know, more capital intensive sectors or in D2C, you know, you have to be much more opportunistic in the types of funding that you pursue. So it's not the first source we would necessarily recommend an entrepreneur go to. I think there are some incredible innovations happening in crowdfunding that allow you to, you know, cast a wider net and not have to deal with 1,000 people on your cap table. That's the one thing that was one of my bigger concerns with crowdfunding in the earlier days, where the issue is that if you're trying to get an amendment to passed or a new round approved, that you have to go to every single individual person. So there are tools today that allow you to do that. I have to say, I'm curious what my co-pals have seen. I haven't seen too many examples of crowdfunding replacing venture capital. I think it's an additional tool that can be helpful to help fill out rounds. AngelList is also something that I know, you know, I've seen multiple companies use AngelList Syndicate. So I think that's something that I've seen on a few different investments that I've been part of.
Thanks. So let me switch gears again, and I'll start with Marnie. And probably all of you have worked with inexperienced entrepreneurs, but Marnie probably I know firsthand, works with the most inexperienced entrepreneurs. What is your expectation around sort of communication, updates, sort of both just from a, regulatory, there's obviously stuff that has to be communicated, but, once an investment is made, what's the expectation of Launch New York in terms of information flow?
Sure. And to your earlier question about the governance piece. So starting with that, we have a side letter when we do what is usually a convertible debt note, and we do require reporting through that letter. We don't generally take a board. We frankly never take a board seat or an observer seat at this time. Frankly, the sheer volume was not something that we were able to accommodate. The reality is that we continue to be involved with mentorship. So from a reporting standpoint, we do ask any of the companies that receive our investment capital, again, it's usually in the form of a convertible debt note. We ask them for monthly financials. We ask them for quarterly updates on additional data, such as we're obviously looking for, information about their employees, employee base, all of that. So our key performance indicators as an organization, since we are grant funded primarily, we do need to show that our companies are raising additional capital besides Launch New York. And we tend to see that on the order of 20 to 30x over time. So it's really important to hear that you do have other investors coming in. And we want to know that through your reporting. It may show up in your financials, but we get more detail in the quarterly reporting. And then we expect that the companies will also be working with a mentor. So we can be tracking and supporting your effort to raise additional dollars. We want to see, obviously, ultimately, that you convert your business growth into an increase in and starting off initial annual revenues and then growth therein, and then that you're increasing your employee base. So for us, we continue to have a very close relationship with our clients. We do call them client companies. We don't charge them anything for our mentorship services, but we continue those. And we also highly recommend that any of you who have raised capital, if you're not currently doing investor reports on a regular basis, at least quarterly, those are incredibly powerful. We don't absolutely require them, but it's as simple as you sending an email off to your investors, because those same investors are going to be the same ones, as Somak said, who either need to agree to something that's happening down the road with your business, or you're wanting them to come in with more capital or help you raise additional capital. So that kind of reporting we highly recommend as part of our investor relations training, if you will.
Got it. And Jennifer, same, and is there anything unique, because from being a state agency, in terms of what you look for once the investment's made? What are updates? What kind of frequency you're looking for? Is there anything unique, maybe because coming from state?
Yeah, so Ken, you know that at Hugo we used to ask people to do weekly, which is, I don't do that anymore. But yeah, we like to, depending a little bit, like we like to at least have a quarterly update. We do have to do an annual survey because we are required to report to our legislature every year on the progress of the program, how many investments we've made, the job creation, job retention in those companies across the state. So there are a few things that are, I think, probably similar to Launch that are more unique. But if we, and then if we serve on the board as observer, we typically have access to, the information that's available to other board members, and the frequency of those can be what I think for the earlier stage companies, it seems to fall on like a quarterly full board meeting and then monthly shorter check-ins. Or about every 6 weeks to have a check-in with our companies. Because sometimes things are moving so fast that waiting 3 months before you check in with your board is too long. And then the later stage companies, we typically do like a 3-month board, or at least we get financials, on a quarterly basis and budgets annually.
Cool. There's a good question here, so let me just run the room here quickly. And in terms of vehicles, I mean, I think you all invest at various stages. So safe, convertible, only priced round. So Matt, let me start with you. I mean, all of the above, or are there only specific ways you're going to make an investment?
Yeah, all of the above. I think most of our investments that we're leading, so if it's a round that we're say our typical round that we're leading has been about 5 million, give or take. We're about to do a potential $8 million investment in the next few weeks. In those type of instances, we're generally leading and setting the terms in terms of a price. So it's a preferred security, typically has a 1x liquidation preference. So, just like any sort of VC round that you can see. And I encourage you, if you go to the National Venture Capital Association, which I know Jennifer's on the board of, we have a standard set of terms that we use as our templates for our traditional Series A preferred rounds. We have done convertible rounds and safe notes. Convertible note rounds are a little bit more common for us when there's a bridge, where we know the company might need an extra few months, a quarter or two, and a new funding round is imminent. A key thing that we have to all determine as an investors with our CEOs is it a bridge or a pier? So is it a bridge to somewhere? So those are typically more the times when we use convertible notes. Generally, though, it's a priced round, a preferred round. As a lead investor, we feel very comfortable setting the terms for the price, and then the hope is to be able to have enough buffer with that valuation, making sure it's fair so that the entrepreneur is not getting overly diluted, but still provides enough upside for investors at our stage and allows us to easily raise the next round without worrying about a down round or having some issue where it's mispriced, which is right now probably one of the biggest issues right now in the entire venture capital industry. A lot of people were raising $100 million rounds, and some cases pre-revenue companies, and those companies that were all unicorns are now in no man's land.
Right. Jennifer, from a state perspective, are there specific vehicles you use or across the board?
No, we will do preferred priced rounds. We'll do safe notes. We'll do convertible notes. So anything is fine. Truly, like, as long as the investor syndicate and we like the company, it's fine.
And Marnie, what about launch? You're on mute, I think.
Sorry, as I wrote in the Q&A, we generally, when we're leading a deal, we use a convertible debt note. And our typical terms are going to be, we're looking at the valuation of the companies. So the valuation cap is generally going to be in the $2.5 to $5 million range. We're typically doing a 2-year maturity on that note, generally a 20% discount and a 6 to 8% interest rate range. So that's when we're leading the deal. And meaning that we're setting the terms and we are papering the deal. We are putting together the legal documents, which a lot of funders do not want to do. So Launch is willing to do that. At certain years, we've been leading as many as 70% of our investments. And I know that the SAFE has become very popular for us. We feel like the convertible, one thing I'll say is SAFEs, they're tending to look more and more like convertible debt notes, with more and more terms being put into them so that the investors have some kind of discount or cap in there. So for us, we find that the convertible debt note tends to be the easiest to put together get an agreement from both the investor and the company. And I will say we have not found any concerns about convertible debt notes from follow-on investors. And our key goal is to make sure that your company is being funded in a way that makes you attractive. Investors are only looking for reasons to say no to your particular investment opportunity. And if it's a mess, if it doesn't look attractive, as Somak mentioned, having down rounds, nobody wants to deal with any of that. There's enough to deal with in startups. So for us, a convertible debt note has actually worked really well. However, Launch New York has also participated. We had one company that has gotten great press out of the Rochester area, Kasana, which has a smart heart seat. So it's a smart toilet seat that's taking biometric measures of cardiac patients at home. That company actually initially worked with Launch New York on a 6-figure round that was going to be a convertible debt note, but the company progressed so quickly that it actually moved right to a preferred round in which we did participate. So we will consider preferred as an option as well. Those are generally, but again, that's probably a couple percentage of our transactions is all. So over 90% are convertible debt notes initially.
Bessemer Venture Partners has on their website for years what they call the anti-portfolio. The ones that got away or the ones that didn't work out. So without naming names, I'll start with you, Somak, because I think there's a lot of lessons learned. You know, you're all very experienced investors now, so you may have to sort of really dig back into your memory. But, you know, there was one that didn't work out, and sort of what did you take away from that? And again, don't name names or anything, but sort of what were some of maybe your early lessons learned that you now make sure, you know, is different when you look at an opportunity?
Yeah. I can name names. I have no issue naming. I'm one. Thankfully, there's not been too many. I don't think, but I mean, it's still important to note that there is. Those are the most expensive lessons, right? If you miss a Google or you miss another opportunity, like that can be very costly. This was. I'm going to caveat this company when I talk about this company. I'm not saying that the entrepreneur was ready to take a term sheet from me, but the fact is we passed when we shouldn't have. It was Pinterest. This was a company that was early on, and I was just. I mean, to be fair, like I think the round was actually Bessemer ended up Sarah Tavel, who's now a partner at Benchmark, led that round. But we were thinking about evaluating an investment. To be fair, we were not that far along, but our office manager, you know, she just was, you know, telling us about how important this product was, how her aunts, her grandma, her sister was using it. And we just had a bunch of men in this room who were like, the idea of pinning boards, like, what a stupid idea, right? And that was something that stuck with me. That was really something I was like, when you talk, I know yeah, Jennifer and Marnie both talked about the importance of diverse teams. We have, you know, a very broad array of backgrounds, a bunch of women who are part of our team and different ethnicities. And I think that's extremely important when you're doing decision making, so you can make more informed decisions. And so that's something that I think my lesson learned from that is don't just rely on the inner circle of people who are experienced investors. There's so many other important things that you miss by not having people on your team who represent the demographic of the people out there. And that's another thing where I think those of us here in upstate, when we invest in some of these industries that we invest in, we have an edge over a lot of our peers because we live and breathe, you know, the types of pain points that our entrepreneurs face in these regions.
Jennifer, either from this life or your past VC life, lesson learned that you are more careful about now or think about differently?
Yeah, consumer product. I was had several lessons learned, and most importantly, I don't like consumer product stuff anymore. It's you know, as much as you get passionate about a particular, unfortunately, I think you can get really passionate really quickly about a particular consumer product. And it's hard to think more broadly sometimes with a lens that, you know, determines adequately whether or not there's, market, a broad enough market or a large enough market to be able to achieve the kind of revenues, especially if it's, you know, we had one, a cherry juice company that it's still operating, but, you know, again, like just to be able to sell a single unit of that product, you know, that so many times over to achieve the level of revenue that was going to really make a go of it. You know, we were a total miss on that one. So, and there are many others like that, but
yeah. Marnie, lesson learned, you want to share?
Fun topic. I think the main thing for me, without naming any names, is sticking to our first intuition that in order to fund this company, XYZ is needed. And to be honest, it usually has to do with growing the team or some kind of steps that the founder needs to take. And really being committed to holding fast to that. So we've been burned where we've said, oh yeah, it looks like you got another team member, or you have that kind of input that we said you needed in order, you know, for us to go ahead with the funding. And then to really find out that it was sort of a half-hearted situation where, you know, no, there really wasn't a team member brought in. Because I will tell you, that's been our biggest issue is it's the people. And if they're not communicating back with a group, if they're not getting advice, we're seeing them going out and spending money in ways that if one other person had looked would not have happened. And yes, monthly financials really should help, you know, doing regular mentorship really should help. But at the end of the day, when you write that check, you know, we are not in there day to day with the company. So really learn the lesson that if we put a contingency out there, we are going to stick to it. And I will only emphasize to everybody on the call that you really have to have more folks helping you, advising you. It only gets trickier when you take money and start spending money. And I agree with Jennifer that some of the areas in the consumer packaged goods, you see huge expenditures, and that's when you really want to know. And these companies are too young for a governing board, but they're spending a lot of money. So I just encourage people to embrace that you can get advisors for free who aren't even taking equity or anything, who want to be helping you.
Thank you. Yeah, I'm working with a lot of consumer goods companies. So starting to, my brain is going 100 miles an hour. Just to set expectation, thank you all for being with us today. We're only going to go to 11. I know the original invite was to 11:30, but in fact, our panelists are extremely busy, so we're only going to 11 today. So I want to, you know, one thing entrepreneurs are always asking myself, all my colleagues, like, is how do I start? How do I get in touch? You know, what's the process? Each of you are very, very different. You know, different organizations. So let me start with you, Jennifer. You have people spread out around the state. What's the sourcing? How do people kick it off?
Yeah, so you know, that it is one of the things that I didn't appreciate fully until I joined New York State, that we have funded centers in every part of the state. We have accelerators and incubators that we've helped to support across the state. We have an office in every single economic development region in the state. Now, I can't say that every single accelerator or office knows us, but most of them do, and you know of us and know how to get in touch with us or to put you in touch with us. We also have, you know, our website. Like I said, there's an email on there. It is monitored. We do respond to things. And on the pre-seed and seed fund, I think I dropped it in the Q&A chat at one point. But our pre-seed and seed fund is an online application process, and you can learn more about that one there. Unfortunately, because of the demand and volume for that program, we have, I think we're close to 400 applicants in about 8 weeks for that. We're just not able to meet with people until, so, you know, there's a lot of information on there. You can put in your application, and as we start to review it and we think it's a fit, then we'll reach out to you then, but we're not able to pre-meet entrepreneurs. We just don't have enough time.
Mm-hmm. So, Mac, you have a small team. So how do people typically find you?
Yeah.
Or your company? Find your folks.
Yeah, our team actually is not as small as it was when I started. So I was definitely a much smaller team when we started to. So we have 8 people now on our team. So no, it's all good. No, it's fine actually, and we're growing actually. So we're going to add probably another person shortly, but we most recently announced a new operating partner, Prab Singh. Best way to get in touch with us, I mean, you can reach out directly. It's a first name at armorysv.com, generally across the team. But I highly encourage you also to reach out to any of the entrepreneurs or any of the other people in the upstate community who know us as well. Any of the people on this call, and if you don't know us already, and also for your perspective, you also can do you can get your insights on what it's like to work with as a type of the companies that we like to back. But we definitely have people reach out directly on our website, and we're very much open for business. But that's and Anthony is really our feet on the street. He's here with me today with some meetings. I encourage you all to get time with Anthony Santaro. He's a 5th generation Central New Yorker, moved back to Syracuse after being in New York City for many years, and that's Anthony at armorysv.com. Yeah.
And Marnie, how do people? I think I know the answer. How do people start with you? Ours
is pretty straightforward, and a lot of people will contact me. In fact, someone did before this saying, "Hey, when can we talk?" I'm your slowest point of contact, so I'm going to recommend you go to launchny.org because you will be able to have an intake call with someone like Ken or El Culleton or some of our other team members within typically a week to 10 days, depending on your availability. We are able to handle large volumes. We are mentoring over 300 clients at any given time. So we highly recommend that, that you basically just apply and that's the best route. Now, if you are in the Southern Tier, we have a wonderful relationship with the Southern Tier Startup Alliance and Ref Ithaca. So they're able to service you if you are in the Southern Tier, and they can be a direct conduit to coming into our funding. So either of those are your best route.
Thank you. So as we're just getting ready to wrap, first of all, these folks are incredibly busy. So I really so thankful that you could spend time with us. I say that with all sincerity, and I'm so fortunate to consider you all colleagues. Just a couple quick announcements on our part. So one thing, self-serving, many of you might know, we run a program here in the summer for people doing hardware products. We're still accepting applications. So both in the clean tech space, funded by NYSERDA, in the ag tech space, funded by the EDA, as well as general sort of anything outside of those two domains. So if you're interested, please, please apply. Rev Ithaca puts on events every month, and probably some of you have been here. Our next event is coming up April 12th. In a couple of weeks, and we're going to be seeing, entrepreneurs, many of which have sort of made the jump from either schoolwork to starting a company or doing community work and starting a company. The events are fun. They're great networking opportunities just to get to meet other people interested in this, in the entrepreneurship space, to get to meet entrepreneurs. And often people who are on the call on the panel today have been in our events. For those of you who are close to Cornell or part of Cornell, there's a big event that's held every year, and post-COVID, we're looking to, it'll be a lot more exciting. But the Entrepreneurship Celebration event, which is a 2-day event, April 13th and 14th, has a number of features to it. There's the Ben Daniel Venture Challenge, there's eLab Demo Day, there's a number of panels, a number of guest speakers. So if you're interested, it's not just for Cornellians. We love to see you there. And then lastly, Cornell is one of 9 National Science Foundation I-Corps hubs. And I-Corps is a fantastic program for early stage entrepreneurs. You heard Marnie talk about Lean Startup and the Business Model Canvas. That's the religion of I-Corps. And we're doing these 4-week mini courses all of the time. So if you're, have an idea and you want to figure out if there's a there and sort of start the process of looking at it from the problem domain and not the technical domain, I-Corps is the program for you. And a number of people in all of the organizations you talked to, we heard from today, have participated in various ways in our I-Corps programs. So I want to thank all of the guests again today. I want to thank Gianna for spending time with us, helping organize this and pulling it all together. And we'll see you all soon. We hope to see you at Rev events, and I hope this was useful. But thank you all for your time today.
Thank you, Ken. Thank you, Marnie and Gianna. Thank you.
Thanks all.
Good to see everybody. Bye-bye.
Thanks, everybody. All right.